Hello, welcome to Planning for Uncertain Times. I'm Jim Cunningham. I have Christina, Lindsey, and Alissa Kroeger from Ascent Wealth Management joining us today. And we're going to cover a brief guide to the potential, or might we say near certainty, tax law changes under the Biden administration. He did pledge in his campaign that he would raise taxes, and we have to take politicians at their word. If they say they're going to do something, then they probably are. So any opening thoughts, Christina, Alissa, on what we're about to cover here before we jump into it?
The opening thoughts is, and keep in mind throughout this presentation, is just that a lot of this is the published agenda of what we're looking to accomplish, of what the Biden administration is looking to accomplish. Published agenda and what is, proposed and what will actually become reality can be two different things. So there's things that we're going to talk about today that are probably highly likely and some that are maybe less likely, but this is everything we need to be thinking about and some things that we need to be able to be reactive to if they come to fruition, and proper planning is key. So I think that's the key thing to keep in mind is we're going to just break down what is proposed and what things we might want to take action on sooner rather than later.
Well, great. Here we are. Alissa, I don't know why your picture's not on here, but Alissa is a financial advisor with Ascent Wealth Management as well. And this is very important, guys. Disclosure, I'm a lawyer. Alissa and Christina are financial advisors. This is not legal advice, okay? This is not financial advice. So we're just information. And
this is not tax advice, even though this is we're going to talk a lot about tax. This is not specific tax advice.
Yeah, and there's no attorney-client relationship or advisor relationship or tax professional relationship happening here. This is just, again, purely for information. So also, go ahead and subscribe to our YouTube page. If you're watching this on YouTube, please hit subscribe. A lot of changes in 2021. I think this is probably one of the biggest change years when it comes to taxes that I've seen in my 25-year career. So I think lots gonna happen this year, but go ahead and subscribe. And 2020 election results, Christina, Alissa, we saw this, the Democrats, and again, this is a no political zone. We're not saying that the Democrats are great and the Republicans are bad or vice versa. I'm just stating facts, okay? So the Democrats control the White House. They do control the House of Representatives, and there is a 50-50 split. And of course, under the US Constitution, the vice president casts the deciding vote. So they have an effective control of the Senate as well. What does it mean when there's one party in control? Well, it's been a long time since one party's been in control. And sometimes things happen and sometimes they don't. So it remains to be seen. But I think a lot of what we're talking about here, the tax increases, it's a lot easier to get through a tax increase than it is a tax cut. So that's something to bear in mind. So any color you want to put on that, Christina or Alissa?
I think the key thing to keep in mind here is while we have Democrat control of all branches of government right now, there are thinner margins in the House. And in the Senate, you still have senators like Joe Manchin and those that are probably going to be a little bit more of a wild card. So this isn't a guarantee that certain things will be passed with a one fell swoop. So I think there is a little bit more balance than I think this tells the story of.
Yeah, and I think, in California, we, of course, have a supermajority, one-party supermajority, the Democratic Party, and that drives a lot of what happens. I think that is an inapposite analogy. That is not what is going on in the federal government. So in California, like what the Democratic Party mandates typically kind of gets through, but that's not the case on the federal level. So if you're a little concerned about that one way or another, pro or con, just because you have this thin majority doesn't mean that it's just carte blanche and it's going to automatically happen. You want to talk about this? The filibuster versus this reconciliation. So what's going on here? And maybe put this in the context of a tax increase as opposed to a tax cut.
Yeah, so some of the things we saw during the Clinton era and is certainly possible is that you may have some fiscal tax policy changes take place through what's called budget reconciliation, as opposed to, which is just, a simple majority. You don't need the whole 60 votes. It's just a simple majority. So with, the vice president could be the deciding simple majority. You could see certain things such as the Tax Cuts and Jobs Act changed or modified or repealed. And so there are certain fiscal things that can take place through budget reconciliation. So again, simple majority as opposed to the full 60 votes needed to pass changes. So,
right now, our maximum income tax rates are 37%. Many people watching this remember when income tax rates were significantly higher. In the 1970s, income tax rates in the early really high. I think it was like 90% in the 50s, right? I mean, so we've had these really high income tax rates before, and we're in kind of a dip when it comes to what you might hear this term historical norm. And all historical norm means is over history, if you kind of put it on a graph, where are we with taxes? And we're actually below the historical norm when it comes to taxation. So we actually have a fairly or comparatively lighter tax burden. It may not seem like it, but we have a comparatively lighter tax burden when looked at a percentage of income. And what we're seeing with the Biden proposal is to go back to more of a historical norm, and the translation is that it's going to be higher taxes. And so let's talk about this number 400,000, Christina. What's going on here?
Yeah, so currently, we know that the top tax rate is 37%. And so one of the major things too that we saw with the 2018, tax changes is we saw that AMT at the federal level, alternative minimum tax, did not affect people unless they were made over $1 million as a married couple, spouses filing jointly. And so, alternative minimum tax, that's the one thing we haven't seen a lot of information on, is what might happen with alternative minimum tax. In California, a lot of the overwhelming majority of dual income households filing jointly were subject to both federal and California alternative minimum tax. So the recent tax changes that we've seen under the Trump administration did alleviate that at the federal level for many clients. Now, this being discussed is increasing the top tax rate from 37 to 39.6. This will happen even if what we're discussing today and the Biden agenda, if nothing gets passed, the taxes are set to sunset in 2025 and revert back to what they were. So I think that this whole 39.6% top tax rate is inevitable. Whether it happens sooner than 2025 or in 2025, taxes are going up. The difference is this under the Biden administration, the goal is to have this apply to incomes 400,000 and above. So a little bit lower threshold.
Well, what's interesting too is, I'll talk to clients and they'll say, well, I don't think this really affects me because, my income's not 400,000. And then when you actually sit down and meet with them, you're like, well, it is. But
yeah, you got to think of dividends, capital gains, all of that.
That's what I'm getting at. So there are some big things that start happening when you start hitting your minimum distributions. Some of our clients have retirement accounts of 500,000. Some have retirement accounts of 5 million. So when you start hitting your minimum distribution and you have 4% of your account coming out at age 72, that's a large, 4% of 5 million is $200,000. So that's a lot of money. And that's taxable as income. The other thing that I think people don't always pay attention to, if you inherit an annuity, right? A lot of times that's going to be taxable as income, and that's just added to your income. If you take a withdrawal from a retirement account, if you inherit a retirement account, if you have a liquidation event, what's that? Well, that's if you sell your business. Many of our clients are, I would say, mass affluent, middle-class people, maybe upper middle class. And if you've worked hard your entire career and built a business and you sell it for $10 million, I mean, that may sound like a lot of money, and it is. That's a liquidation. And that's a taxable event. And that's when we start looking at income tax, capital gains tax, recapture depreciation. We start looking at all these different taxes. So if you think, well, that really doesn't apply to me, I would just kind of take a pause on that and say, it probably is a good idea to meet with an expert, whether it's Christina or I or what other, so as long as they're a qualified expert, to go through this and take a look at it and anticipate, because one thing I don't like economic surprises, right? I mean, I can intellectually accept paying taxes. I don't lose my mind. If I get surprised, that's kind of when I lose my mind, but I just don't want to be surprised. Okay. So, I mean, this is part of it, is knowing what's ahead. And so Christina
Yes.
and Alissa and I help many, many clients when they know that they've got this big tax uh, burden coming up. There are a lot of things that you can do to minimize it, to delay it, to avoid the tax entirely. So, I mean, there's a whole universe of planning strategies out there that frankly are well used, and they're not risky, and they're just pretty straightforward. You just, if you don't know what you don't know, that's the problem.
And so that's where we don't know, there's not been a whole lot of clarity as to whether the 400,000 an income above 400,000 is going to apply to single filers or joint filers. So it's a bit unclear. So that's going to be one of the things that when it comes to filing, and if, once we have clarity on that, that would be something you definitely want to review with your CPA as your filing strategy.
So let's talk about qualified dividends. If you can explain what a qualified dividend is, and explain what those terms are: long-term capital gain and qualified dividend.
Yeah, so long-term capital gain is when you hold something for 12 months and a day. So something over a year. So for example, the recent GameStop scenario that we've all seen, and someone bought GameStop at $50 a share, and if they sold it for $300 a share, you're going to pay a gain of $250 per share added as ordinary income if you did day trading and if you sold things within less than a year. So there's a difference between gambling and investing. And most investors.
Hold on, but with GameStop, I think that's probably gambling anyway.
It was gambling. Yes, it was gambling. So, some people made money, some people lost money. So if you lost money and you sold in the short term, it is a short-term loss. If you have a short-term gain, that is treated as ordinary income. Ordinary income. So if you're in the top tax bracket and you are going to get bumped to 39.6%, and then you tack on the 3.8% net investment income tax, which is the Obamacare tax. So that was the Affordable Care Act tax that came through Obamacare, and it applies to net investment income tax gain. So tack on 3.8%, you're at 43.4% federal tax. California does not have a long-term capital gains tax rate. Everything is ordinary income. So tack on another 13%. And you're looking at 57% taxable gain if we lose the long-term gains rate. Currently, long-term capital gains rates are at either 15% or 20. And in most cases, the net investment income tax applies. So let's just call it 18.8 or 23.8. That's the current long-term capital gains rate. So 23.8 or 8, it's dependent upon income. So if you earn less than $450,000 a year, your long-term capital gains rate is 18.8% federally. So it's significantly less than the top marginal tax bracket for ordinary income. So typically most people look to hold things if they've owned Apple stock, for instance, for years and years and years, and they bought it at $100 per share and now it's $500 per share. They're going to be able to sell that and pay the long-term capital gains rates as opposed to the short-term ordinary income gains rates.
Yeah, of course, under current law, if you're married, property is community property, and one spouse dies, the surviving spouse, the one who's alive, can sell those assets.
Correct.
Capital gains tax, because you get what's called an adjusted cost basis. That's a very powerful tool that's currently available. But why this is really important and why we're kind of focusing on this is two things. One is, we'll talk about this a little bit later, there is a proposal, although it's probably unlikely to happen, but could, to eliminate adjusted basis at death, right? So you lose that adjusted cost basis at death. And also, I do want to go back to what I said about, the liquidation event. Is if you have a business, if you have a family business, if you're selling a business, you really could get jammed up with this higher capital gains tax rate. And also Biden's talking about getting rid of the 1031 exchange, the tax deferred exchange.
We're going to get to that.
Yeah.
We're going to get to that.
Remember this $1 million thing. So, all right, let's talk about the income tax changes.
Yes. And so, just keep in mind that if they're looking at that for people that have earned income of $1 million or more. So, if you're in your high income earning years and you have or have the sale, as Jim mentioned, have the sale of an asset that would throw you into that particular year having a higher taxable income, you may want to look at considering selling some highly appreciated assets. And so we don't need to make that decision today, but you do need to be working with an expert so that if this were to come into effect, even at the end of 2021, we can react and go, let's start harvesting some of these gains at a lower tax rate as opposed to waiting. So,
another is some people, Christina and Alissa, they have invested in certain types of investments where they end up with negative cost basis. And so when they unwind these investments, many times those tax cows come home. And it just depends on the structure of your investments. I'm not saying they're good or they're bad, but sometimes people will have a taxable event and they don't get any money. So it's very important to really pay attention to this stuff. And again, we don't like economic surprises. We like to know what's coming down the road. So let's talk about this. What is this 28% ceiling on itemized deductions? What does that mean?
So currently, let's see here where the current ceiling is. I was just looking at my notes. So basically, they're looking at bringing back the P's limitation. And that's really what this is. And that would mean that there would be a cap. So, currently your itemized deductions, for example, in California, we have what's called the SALT, the state and local taxes. Those can only be deducted up to $10,000. And so what they're looking at doing is capping the amount of your income. You can only itemize deductions up to 28%. So
if you have a deduction of $100, you're not going to take 39.6 cents off your taxes. You're only going to take 28 cents off your taxes is the bottom. So it kind of, it pinches you a little bit on the amount of your deduction. And this would apply to all deductions on your 1040, right?
Yep.
Mortgage income applies to state and local taxes. It applies to all these things. So very important. I mean, is it a needle mover? I don't know.
Depends on how much you itemize and what your charitable contributions are, if you're a business owner, what your corporate tax structure is. But it would be a reduction in itemized deductions, 3% for every dollar above the threshold. And so, currently, again, the SALT cap being at $10,000, that's one of the things that even if the Tax Cuts and Jobs Act does not get repealed, there's a lot of conversation right now about repealing the SALT tax because there's a lot of Congress people in California and New Jersey that are looking at getting rid of that cap because we all know that we're paying more in property taxes and local taxes.
So do you think that's likely that we'll get back the deductions for state and local tax? What do you, because you kind of have your ear to the rail on this stuff.
Personally, and speaking with some of the congressmen in California, even on the Republican side, that this is not a Democrat or a Republican issue. Really, this is, both Republicans and Democrat Congress people are looking at proposing a repeal to that component. So whether it'll pass, still to be seen. But I think that if some of these Congress people want to get reelected and representing California, they're certainly looking at trying to repeal that. So that's something that we would, probably if we don't see a whole repeal of the Tax Cuts and Jobs Act, which, I think is probably unlikely that we'll see a full repeal. I know Biden's in favor of it, but again, not being able to get that through the majority, I think that it's likely we'll see bits and pieces. And so the SALT is probably one that is more probable than unprobable. What we're also starting to hear as far as anything that pertains to income tax changes. So currently for Social Security tax, both the employer and the employee contribute towards Social Security at a total combined rate of 12.4%. So 6.2% the employee pays and 6.2% the employer pays in every paycheck. That is assessed up to wages of $142,800. It's adjusted for inflation every year, but it's minimal. So the total amount of wages that go towards paying Social Security tax is $142,800 currently.
And above that, there's nothing. So
above that, there's nothing. So if your W-2 is 300, you're not paying it on anything over the 142.8. Your employer's not, and your employee's not. And so what they're talking about doing is doing the tax on wages up to $142,800, which includes bonuses, your gross compensation, taxable wages. They're talking about having no tax on anything between that and 400,000, and then bringing it back on any W-2 wages for 400,000 and above.
What about stock?
Yeah, stock options, if they're ISOs and they vest and they're taxable that year, that's considered part of your total compensation. So
you exercise stock options and it puts you over the 400,000. I'm for the math to add up when I bring in the income taxes and the payroll tax. I wonder if
you're fading in and out just a bit, Jim, in your volume. Sorry.
How is it now?
You're good. You're good. And so, that's one thing that I think that, will it be necessarily the 400? Will there be the donut hole where you don't have any wage earners in between that? And those are typically things that we see work out in the details where there's always usually some compromise. So I think that's yet to be seen, but it's one of the real areas where Social Security being underfunded, this is one of the ways where I think this is inevitable that we're going to see additional Social Security taxes on wages.
So one cool thing was the qualified business income deduction for pass-through entry on from the Tax Cuts and Jobs Act. And that's the 20% deduction. So if you're in business and you're not a financial professional or a lawyer.
I'm sorry, Jim, your volume is coming in and out.
Yeah, having a little audio issue here. Sorry about that.
That's better.
Okay, good. So if all right, I'll let you take this. I'm having an audio issue here.
Yeah, you're having some audio. I'll take over. Sorry for a second, Jim. Yeah, so the elimination of the qualified business income deduction. So essentially that applies a lot to rental and passive, real estate investments as well. So it basically says the first 20% of that income is not taxable. And so that would be a big one where that's provided a huge benefit to a lot of people, business owners, passive investment owners, real estate owners. So if that gets eliminated, that's probably a big one that would affect a lot of people. So this is kind of where, I think that even just your average retiree that has pass-through income from rentals and is in a, normal income bracket, that's probably one that I think is probably a little less likely to go through. But we'll see. Who knows? So that's what's being discussed is elimination of the qualified business income deduction. We're also, here's the big one. And this is what we've heard time and time and time again is going after the 1031 exchange market. And so Jim and I have done a webinar on, it is available that talks about 1031 exchanges and things that we can do for our clients with respect to rental property. But they are talking about eliminating 1031 exchanges for anyone that has an income above 400,000. Now we've heard two things. We've heard it being eliminated for any income above 400,000. This is kind of what's been recently published, but during the campaign, we also heard you can do a 1031 exchange of property up to $1 million of value. And that would be anything over $1 million, you can't get an exchange on. So that's kind of where we, whether it be one or the other, we know that there is a lot of threat to the 1031 market. So I want to come back to that in just a moment. But what I first want to talk about is also the corporate tax rate increase. And so this is a big deal. And so they're looking at increasing corporate taxes from 21% to 28%. So if you can go to the next slide, Jim, what we can look at is, this is a slide that we actually put together back in 2016 when we were looking at the implementation of the new Trump tax administration, the Trump tax laws. And so corporate taxes in the US were 35%. I'm sorry, 39%. And so we were the highest, almost the highest in the world, and they needed to come down. They absolutely needed to come down. And so we were just simply not competitive, and we wonder why we've lost all the manufacturing overseas, et cetera. Here's a really good example of where you can see where the diamond being what the tax rates were in 2006 for many of the top leaders for import exports around the world that we do a lot of trade with, what their corporate taxes were in 2006 and what they were in 2016. You can see that we were the only nation that didn't lower them for decades. And so we were simply not competitive. And I can tell you a small story I was sharing with Jim. I used to work in private equity for a Canadian company, and we funneled every bit of our income for the US up to Canada to pay 27% as opposed to 39%. And that was just the owner's responsibility to the shareholders to make sure that they were being fiscally responsible. So it was necessary to lower corporate taxes. So if we go back from 21, the UK's at 20, Japan's at 30, Canada's at 27, our neighbors to the north. So, the average is still around 28. Whether we'll go from 21 to 28 or somewhere in the middle, I think that's, still to be determined. But that's one of the things that lower corporate taxes did, was it was a huge contributor to future earnings for corporations. And we've seen massive returns in the stock market because of the tax cuts.
So Jack has a question. He goes, basically, this is like, come on, isn't the effective tax rate lower for corporations in the US? What company pay? Isn't it much? I mean, isn't it basically zero or not?
Not true, only because most, a lot of times people want to talk and pick on the big corporations. And certainly do, like the big corporations have many different tax shelters, the Amazons, the Walmarts, and, and what we've seen through the pandemic is probably the largest redistribution of wealth to these larger big companies that we've seen in our history of our lifetime. And so some of those large companies, Facebook, the big tech, do they pay less corporate effective tax rate? Yes. But the bread and butter of the backbone of the US economy, which is small and mid-sized businesses that have 20 or so average employees, they are paying an effective tax rate in the 20s. And then on top of that, paying the 12.4% Social Security tax and all of those things, the employer-employee FICA tax. So Medicare surcharges on top of that. So, we do need to make sure that we're competitive as a nation, but the biggest things is when corporations get taxed more, that means they're hiring less. There's, it's going to have an effect on total jobs. It means it has a direct effect on the bottom line of their corporate earnings. So if we are in a rising rate environment, eventually, right now we know rates are lower for longer, but I think most economists are in the camp that we're going to see, rising interest rates, inflation, probably late 2022. If we have higher interest rates in corporations, it costs more to borrow at a higher rate, and they're having to pay more corporate taxes, there's going to be a little bit less earnings. And at the end of the day, the only thing stock prices are driven by is earnings. If corporations are making money, stock prices are going up. So that would be something that when we see this come into play and we see an actual piece of legislation that gets passed, there will probably be a market adjustment for that. And that's one of the things we have to be mindful of.
Yeah. And so I would say on an action item, if you're thinking about selling, okay, if you're kind of on the, you're like, well, you get this flag, tired of fixing leaking faucets and toilets, or I'd really like deferred exchange of a piece of property. Would give me a headache. Check out our YouTube page, number one. We have several webinars there about how to not pay cap, and then what you do with your assets, what you do sales pro. So it's not paid what do I
And
do?
What
with proceeds?
Jim, you're coming in and out a lot. I'm catching.
On our YouTube, several things like this. Take a look at. But here's what I would do. This law may pass in the fall, and do this webinar in February. So if you're thinking about doing this, I would suggest you pick up the pace, right? And
So Jim, I'm sorry, you're still coming in and out.
Because it takes a while to sell, right? So I don't know if you put any color on that.
Yeah, sorry, Jim. You're we're getting some comments here. Your audio is still coming in and out, and I'm not sure.
Killing me.
I know we did a sound check right before, so sorry, apologies, guys. But kind of to reiterate what Jim was speaking about is kind of going back to the 1031 issue. So again, a 1031 exchange is if you have a piece of real estate, and let's just say you have a rental home and you want to sell it, but you just don't want to pay the capital gains. You bought it for $200,000. It's been fully depreciated over the last 15 years that you've rented it out. And now it's worth, $500,000 or $600,000. You don't want to pay that amount of capital gains. Because again, in California, if you're in the top tax rate, you still could be looking at paying over 53% in taxes. Capital gains, you could be looking at 35, 37% in capital gains taxes. So it's still a significant amount because California does not have a capital gains differential on taxes. So what we look at doing for a lot of our clients is if they can sell that property, they can exchange it into a like-kind investment type of real estate, and they can then defer the gain. Their kids can still get a step up in basis, or the surviving spouse if you own it in a trust. So at the death of the first spouse, if you bought the property for $200, it's now worth $600. At the death of the first spouse, they can sell that asset without gain under the current tax law. And one of the things that we do offer is professionally managed portfolios of real estate. And most of those are paying between 4 and 5% net cash on cash returns. So if you have, $1 million invested, you can count on having anywhere from $40,000 to $45,000 a year, $40,000 to $45,000 a year in net cash flow without paying renter, property managers, and those kinds of things. So a lot of times people think they're beholden to doing, if you own a rental property and you're personally managing it, you're beholden to buying another residential property that you're having to manage. There are ways to sell these assets and go into a professionally managed portfolio outside of California. Owning, most of these are basically things like industrial warehouse distribution centers, multifamily apartment buildings that you're a shareholder and you're collecting a rent check. So if you're thinking about doing a 1031 exchange, that is probably the thing that we're hearing the most about from the administration as far as tax law proposed changes. So definitely, speak to us and we can do an analysis for you. We can analyze your current cap rates, your current cash flow, your actual rate of return, and see if an exchange may make sense for you. So,
by the way, popular. I don't know. All right, you're gonna.
I'm so sorry, Jim. I promise we did a sound check and this wasn't happening. It sounds like maybe something might have a loose connection. I'm not so sure what's going on. Or if you have ear pods, maybe. I don't know if you have ear pods, but but you are in control of the slide deck. Can we go back one or two, just make sure I'm on the right track, Jim? Okay, yeah, so let's go to, whoops, go. Go the other direction.
I'm having a day. All right.
We'll get there. There we go. Okay, like the next slide. Okay. So gift tax changes and annual exclusions. This is a big one. So one of the current annual gift tax is basically set at $15,000 annually per donee. What that means is I could walk into the Arco Arena or the Staples Center and I can basically go, if I have a stack of cash, I can go, you can get 15,000, you can get 15,000, you can get 15,000, you can get 15,000. There's no limit as long as I'm not giving one person more than 15,000. The new The new proposed gift taxes are basically, I can only walk into the Staples Center with 50,000 and that's it. So per donor. So, husband and wife, married couple can only gift $100,000. And then what it may do is also limit, this is the big one, it may limit the lifetime gift exemption, different from estate tax. Gifting, it may limit that to $1 million. So currently the gift tax and lifetime gifting and estate tax limits 11.7 million per person. This is looking at making it a separate gift limit of $1 million of lifetime gifting. And so now is definitely the time to look at, especially if you have a family business or looking at gifting, real estate. You might have a cap of being able to only gift $1 million in your lifetime. So that would be some significant estate planning that could be, up for consideration.
Yeah. That's right.
If you want to type into me, Jim, you can. Okay, so we're going to talk about, the next thing is really restricting valuation discounts. So some of the things that, can be discounted currently for estate tax and estate planning purposes is, let's just say you have a family business and, it's a fairly illiquid, not a marketable security business. And so it's valuing it is kind of difficult because, if you were to transfer it or sell it to someone outside of the family, valuation is difficult. So essentially there's current tax law and estate planning tax rules that basically allow, if you have a business, let's just say, if it could be worth $1 million, you can discount it because it's not a marketable business by anywhere from 35 to 50%. Most of it's about 35%. So that the value as far as what's includable in your gross estate is only 750,000. Or 650,000 rather. And so what you're looking at is a change to that and eliminating the valuation discounts. And so that would definitely be something you want to sit down and review your estate plan, especially if you have any kind of family businesses or intra-family gifting that you're looking to do. So that would be something you want to sit down with your estate planning attorney and sit down with Cunningham Legal and review that. Grantor retained annuity trusts. The proposed minimum term is going to go potentially to 10 years. And so that's a big change too. So if you have any form of a retained annuity, definitely worth sitting down and reviewing that, or are looking at doing that kind of a strategy, especially for, intra-family buy, sell, or anything like that. That's important to sit down and review that sooner rather than later. So as Jim mentioned, if you wait to do your gifting, you may be out of luck, especially if you've already used some of your lifetime exemption. And so even funding, one of the things that I want to mention here is even funding an ILIT, an irrevocable life insurance trust. That was something that people used to do when we had lower estate tax limits. That could be something we start doing again if we see lower estate tax limits. And you have to use some of your gift exemption to fund that. So those are things that we really need to review. If you have an ILIT, an irrevocable life insurance and trust, specifically to cover estate taxes due, this is something you need to sit down and review. You need to review the insurance policy and you need to review the trust documents. Estate tax changes. Having an estate tax reduction, so it could potentially, we're hearing both, it could go to 5 million, adjusted for inflation, which was the 2010 situation, is 5 million per spouse, where you're capped at a total of $10 million, which includes, your home, the value of your business, it includes your trust accounts, it includes your cash accounts. So all of your stock, all of your bonds, plus all of your real estate. If the total value is greater than $5 million per person, it could create an estate tax due. So we've been in this era of the last several years, $11.7 million per person. Most people have not had to pay an estate tax. This could change drastically, especially if you've got California real estate worth $1.5 million on a residence in California. Not hard to do to get to those limits a little quicker. It's also being discussed at being a $3.5 million static level. And Jim, do you want to try see if your audio is working?
Yeah. How's that sounding?
Still an echo.
Nope.
So
Not two microphones.
okay, you got two microphones on. Okay. You just have one. Okay. You could also call in. You can mute yourself and call in. You can mute yourself and call in if you want to. Okay. And then as far as estate tax rate increase, this is one that I don't think anyone seems to mind if this goes. This is kind of one of those wealth taxes that there's a possibility of 45% surtax on ultra high net worth estates. So estates worth over $1 billion, the Zuckerbergs of the world, I don't think anyone minds if they're paying a little more estate tax. So that's not going to affect as many people. Action item number 4. Now is the time to seek expert advice. Definitely, if any of these things that we've talked about are a concern, you certainly want to book a time to meet with Cunningham Legal or Ascent Wealth Management, and we can do a complimentary consultation. And so one of the things that I really like to speak to is my father is a business partner of ours as well. And my father and I have been working with Jim for over, Jim and my father, you and John have been working together for nearly 25 years. One of the things we always like to say is you want to have kind of a 3-legged stool. You want to have your certified financial planner, your CPA, and your estate planning attorney all working in tandem. If you don't have them all working in tandem and coordinating your taxes, your estate plan, your financial plan, then you don't have a proper team. And especially with all of these potential changes, you need to have a team that is really working for you and looking down the road as to what these potential changes could be. So estate tax changes, this is a big one. We're hearing a lot of talk about it. It is a grave concern if this were to go into effect. The elimination of the stepped up basis. And so if you have a step up in basis, currently you have a step up in basis. So if Jim, you and your wife bought a property for $500,000 and it's now worth $1 million, and you were to pass away, your wife would be able to inherit it at $1 million and sell it without any capital gain due, aside from any of the marital exclusion on your primary residence. So that is one big deal, especially if you have a lot of our clients have rental properties. Again, go back to the 1031 issue is, so if you have a rental property that you bought for $200,000 and it's now worth $1 million, and you pass away, your kids can inherit that at $1 million and sell it without any tax due. There is a lot of conversation of elimination of stepped up and step up basis. Now, this is it. They could decide to do elimination of step up basis on rental real estate, but not on stocks and primary homes. So there's so much unknown with this. The one thing that we do think is, as far as eliminating step up basis across the board, most people think highly, highly unlikely. And the only reason we say that is because the cost, if anyone looks back at 2010 and anyone that died in 2010, I know, Jim, you went through cases like this. This was kind of the case in 2010. It was a nightmare, and not many tax forms, IRS, corporations, they didn't have the accounting or the proper documents to deal with this. So this would be such a massive accounting change for our nation and so many systems that we have in place. The cost involved of trying to keep an accounting record of that would be terribly difficult. So that's why we think this being an across the board issue, probably highly unlikely, but something to consider. So I think that those are kind of the main things that we wanted to talk about. And this will be available on Cunningham Legal's YouTube channel. I know Jim was hoping to contribute a little bit more.
Christina, about 10:30. I'm echoing.
Apologies, guys. It looks like my audio is the only one that's working today. I don't think you wanted to hear it entirely from me. So many apologies, and definitely want to open it up to some questions. This will be on YouTube. And as Jim had mentioned, we do have another YouTube video that we spoke specifically about a couple things. We spoke about 1031s and 1031 exchanges. We did speak about that on a completely separate webinar and really what are options for people that have rental real estate. We also spoke about about a month ago, I think in January, we spoke about, look, taxes are going, as long as you're in the camp of taxes are going up, whether they sunset in 2025 and go back to the old rates, or we see change prior to that with the current administration. I think most people are in the camp of taxes are going to go up, especially to cover all the stimulus spending. And those are things that I think that if you're not in the camp, taxes are going up, fine. But I think that most people are in the camp that they are. We did do a whole strategy of what to do as far as looking at paying maybe a little more taxes or accelerating taxes now, some strategies for that. In particular, looking at how to look at your IRAs and large 401ks to make sure that you pay less tax when those required distributions come due at 72. We have a whole webinar on that as well. So definitely look at the YouTube channel, subscribe to that for Cunningham Legal. And I'm going to go ahead and open it up to questions. And I know that we've got a couple questions in here. So I'm going to look at a couple of things. I was just checking the chat too. So we've got
in the Q&A.
Yep, in the Q&A. We've got our 1031s, 721 UPREIT opportunity zone transactions more or less attractive relative to the proposed tax law changes. That is a great question. So with respect to qualified opportunity zones, which are going to run out at the end of this year. So 2021 is the last opportunity to basically, there are various forms of qualified opportunity zones. We can certainly discuss that with you. We do offer private equity qualified opportunity zones, which is an opportunity to defer and eliminate some of your taxable capital gains. So that's probably something we should take offline because those do apply exclusively to accredited investors. There is a lockup period of time. There are some where you can basically defer the gain into these investment zones and not have any cash flow for 10 years and then sell it in 10 years and sell it completely free of capital gain. Any of the gain that you rolled into that investment, as well as any gain on that investment, would come out tax-free after 10 years because it's going into a qualified opportunity zone. There are some that are redevelopment zones that are designed to help boost economic activity in certain markets. There are some that do provide cash flow after a couple of years. So there are a variety of those. And to get into that is a whole nother ball of wax, but qualified opportunity zones are also a good potential strategy. But it really depends on what your circumstances are, whether you need the cash flow or not. Possible changes in taxes for death benefits in life insurance. We have not heard of any taxable change on death benefits for life insurance. And so one of the things that's actually probably a benefit in the life insurance arena, taxability on death on life insurance, I think that the likelihood of ever seeing that is highly, highly unlikely. And so that's why the insurance market exists. And so that is not something that I think we will ever see. But what we can say is that there are certain ways to overfund life insurance. And with changes in the actuarial tables, people living longer, there used to be what's called well, there still is. There's a way to MEC out your policy, which just basically changes the taxation of your policy if you take any of the cash value out of it. So I'm not talking term policies. I'm talking permanent life insurance policies that have cash value in them. You can do what's called MEC. You can it turns your contract into a modified endowment contract, which means if you take cash out prior to death, it's taxed as ordinary income. There is a way to make sure that you're most of the time that happens if you overfund it in the first 7 years. Now they're changing some of the rules on that so that we can probably put more money in and make sure that it doesn't get that MEC tax status so that you can take money out later and use it as a retirement vehicle for tax-free income and take some income out without taxation. And there's a way to overfund it better now than used to be. So there's some changes in the life insurance arena on that. Death benefit being taxable, no.
I will add I'll type it.
So we have another question. How do we turn on, or how do we turn our college town multi-unit rental into a non-profit through self-managed scholarships? Contact Jim. Contact Jim. This is an estate planning tool where we could look at doing a potential, private foundation, a charitable remainder trust, a charitable lead trust. There's all kinds of charitable planning tools, and it really would be specific to you. But definitely looking at that now, if we do have changes on gifting limits and those kinds of things. So that is something you want to definitely sit down with Cunningham Legal, book an appointment. So for Cunningham Legal with estate planning questions, you can go to CunninghamLegal.com and you can book an appointment there for questions and anything wealth management related, 1031 related. Those would be things that we would work in coordination with Cunningham Legal, and you can certainly reach out to our office directly. We have both Northern and Southern California offices. We've got our phone numbers listed here, and you could reach out to Laura, and her email's up here as well. And then Alissa mentioned, let's see here, we answered this question here. If anyone has any other questions, please type it into the Q&A and we will wrap it up here in just a moment. Yeah, and once we do have more clarification on the MEC rules and modified endowment contract and any life insurance changes, we'll probably have another webinar. But really, essentially, this kind of goes back to our webinar. If you guys go back to the YouTube channel, look at the webinar Jim and I did on doing IRA strip out strategies, accelerating some of the taxes now in order to defer what will be a higher tax rate environment later on large 401ks and IRAs. There is an ability to do that to a greater extent because of some of the changes in the MEC rules. We can actually fund it a little bit on a more accelerated basis. So definitely go back and look at that. And we certainly thank you for the time. We hope you were able to hear me clearly throughout. And I sorry that it was more of me and less of Jim. And we thank you for your time. Thanks, everybody.